We'll start with stock of the day. And this one is a suggestion from Claude. I'll give you that, Claude. It's a good one because, of course, we've had Xero out with its half-yearly result. A loss of $5.9 million versus a profit in the first half of last year of $34 million. Revenue, though, was up 23% to $505.7 million. And we're also seeing around 23% rise in subscribers as well, with monthly recurring revenue passing that $1 billion mark for the first time. Now, looking forward, the company says that total operating expenses are likely to rise, but that its acquisition of Planday should continue to see revenue grow in the new year. Now, I will timestamp this again. You guys are used to me by now. We're just past noon here in Sydney on this Thursday, and the share price is down by 5%. Claude, I'll start with you since it was your pick. You're keen to talk about it. The market's treating this update pretty negatively. How about you?
Well, I wouldn't be overly negative, although I can understand why the market is negative. Basically, I would say that for a company Xero size, the performance versus analyst estimates has a huge impact on at least the initial market reaction to any results. And basically, these came in a bit under what analysts were expecting, according to CapIQ. Especially on the profit line, the EBIT was a fair bit lower. I think maybe only around half what analysts were expecting, and then it was actually a small loss instead of, I think, that analysts had it as making a small profit off the top of my head there. So, basically that's probably explained some of the initial move lower. Having said that, I think the other part of the pie, in order to understand why the stock is down a little bit today, is that expectations around this company are really high. It's a real market darling, and because it's such high quality, you have a situation where, yes, it has over $1 billion in annualized monthly recurring revenue now, but it has a market cap of, I think, about $21 billion. And so it works out at being, even after the move down today, at about 18 or 19 times annualized monthly recurring revenue, which is fairly expensive for a company that is, only not necessarily growing fast enough, although you would argue that probably 23% operating revenue growth is maybe enough to justify that kind of multiple if you can keep up that revenue growth for a long enough time. So there's many years of strong growth being priced in by the market. So yeah, when the results come in below expectations, it's not surprising to see the share price down. Having said that, I actually own only a tiny amount of Xero shares because I thought it was so expensive. There's so many expectations around it. Having said that, I've always been saying to myself, I'll buy the dip one time when it's better price, I'll load up. And, I did buy a little bit in March 2020, but then not enough, and I didn't go aggressively enough. So it's one of those ones where it's always probably going to be expensively priced, and that's because it has a great business model. It's very sticky, very low churn. Churn actually went down even in these results, which were not the best, but the churn went down, showing the strength of the business. And what makes it so good is that it's still spending lots of R&D to make the ecosystem stronger, and its app store lets small businesses choose from more than 1,000 connected apps. So what that means is that you're tapping into this resource of entrepreneurial sort of software development companies to try and solve all these little problems on your platform. And then what's happening is they said on the call, which by the way is probably still going now, just listening to this right before I came onto this show, but Xero is now receiving a 15% commission on new customers who sign up to an app through the Xero app store. That shows that kind of business model is starting to kick in, which is what makes it so attractive. And yeah, basically on the product development side, things look pretty healthy. Having said that, yeah, the stock's a bit down today. I personally hold shares as disclosure, and I think it's a really high quality business. It's just about the price, whether it's low enough to buy yet.
Is it low enough to buy yet? Because you could be waiting, if it's such a high quality stock, for a very long time to see a more significant pullback, correct? Or might that change if we start to see, say, interest rates rise?
Yeah, so definitely interest rates rise, you've named it, could probably be the number one risk why you'd see downside volatility on this kind of growth stock. And so personally, I don't think I'm going to be buying today, but in my personal portfolio, I'm pretty fully invested. When I take control of my superannuation in an SMSF sometime early next year, I probably will allocate some to Xero just because it's such a high quality company, but how much I allocate would depend on the share price at the time. Generally speaking, I like to have a little bit of the really high quality companies because they might never get cheap. So at least if they keep going up that way, I'll benefit somewhat. But also having a little bit of it is a reminder to me that I would like to load up if it does get cheaper.
Cool. All right, Carl, how about you? What are the signals telling you in terms of the Xero share price and whether it would be a buy today?
Yeah, not a buy yet on the chart. Not to say that it won't be or couldn't be in the short term. So it is actually interacting with, if you are familiar with my charts, that dark green zone, so that long-term trend zone, which tends to act as support. It's not visible on the chart on screen, but it kind of kicks in just around where just above where the lows were back in October. So it's sort of in there. But support level, just talking about technical analysis here, support level is not a support level until you see the demand coming in, and the demand manifests itself in the market through the candlestick, so through white candles and through shadows on those candles pointing down. If you don't know what candles are, go to Google and learn what they are. But you're looking for white candles and shadows pointing down in the zone. So it's in the zone now. And by this I mean I'm not going to rush out and buy it just because it's in the zone. I need to see evidence of that demand. Until those candles appear, I'm probably not going to run out and buy it. But the long-term trend is up, so you are still looking to buy those pullbacks. I agree with Claude in terms of the quality of the stock. Brokers have massive projections on what this thing is going to do. I'll just give you an insight. I think it's valuable for viewers to understand the valuation, because the valuation is always elevated. I mean, it's trading on 1,500 times this year's earnings. Sounds like a lot, but if this year's earnings are going to be about 10 cents a share, next year's earnings they're forecasting to be 50 cents a share, Nadine. So that is, a massive growth, 10 cents to 50 cents. And then the year after that, up to just over 80 cents, the year after that into $1.50. So there's a huge growth runway coming up, and that justifies these high valuations we're seeing now. So first point, watching for a buy around this level. Second point, don't be scared away by the valuation metrics. They're going to get a lot better. And finally, just on the half-yearly result today, a couple of things. They look disappointing about some of the headline numbers, but they are spending money to make money down the track. And the other thing I note is they did raise their prices very recently, so margins improved, tick, 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 and churn, as Claude said, went down. How about that? Fewer than 1% churn, which I'm not sure if there is another business out there that has less churn than that for a subscription-based model. So raised prices, churn went down. I mean, that's really, for me, all you need to know about the fundamentals or that result.